Welcome back, everyone. I'm absolutely thrilled to have you here for another explainer. Today, we're taking a deep, focused dive into some of the absolute trickiest areas of the June 2026 ACCA Financial Management syllabus. Seriously, if you're looking to bridge that gap between basic, clean financial theory and the messy, real-world constraints of corporate finance, you are in the exact right place. We're going to break down some seriously heavy-hitting topics, making them crystal clear and super easy to remember. Let me start off by asking you something directly. Is your positive NPV project actually profitable? Really think about it for a second. In your standard finance textbooks, a positive net present value is the ultimate green light, right? You crunch the numbers, the result is greater than zero, boom, you launch the project. But in reality, well, the truth is way more complicated. It's kind of full of these hidden traps that can literally turn a theoretical winner into a complete cash-burning disaster. Okay, let's dive right into this. In a perfect textbook world, NPV assumes these nice theoretical cash flows in perfect markets with unlimited funding. Sounds great, right? But out here in the real world, the government always takes a cut through taxes. The purchasing power of your money? Yeah, that drops over time because of inflation. And banks? They're definitely going to limit the cash available to you. So to actually evaluate an investment, we have to yank NPV out of the textbook and throw it right into the messy real world. So here is our roadmap for today's explainer. We'll kick things off by moving beyond basic NPV, then we'll tackle capital allowances and taxes, and after that, we're taking on inflation in NPV. Next up is surviving capital rationing, and we'll wrap the whole thing up by avoiding common exam traps. All right, let's set our baseline and jump straight into Section 1, moving beyond basic NPV. Now, before we start piling on the complex layers, we really need to remember the golden rule of basic NPV, which is to isolate future incremental cash flows. That means strictly excluding sunk costs, that money you've already spent and just can't recover, and also tossing out any committed costs that are unavoidable. But while this sets our baseline, we've got to prepare our calculations for real-world variables, things like working capital requirements and taxation. And that brings us right to our first major real-world hurdle. Let's look at Section 2, Capital Allowances and Taxes, or, as I like to call it, dealing with the government's cut. So, what are they? Capital allowances represent tax relief on your capital expenditure. Putting it simply, when your business goes out and buys an asset, the government actually lets you deduct a portion of that cost from your taxable profit. This creates what we call a tax shield. And let me tell you, it is incredibly valuable because it's a completely legal way to save cash that would otherwise just go straight to the tax authorities. Now, what's really interesting here is the massive difference between accounting profit and actual cash flow. Just think about depreciation versus capital allowances. Depreciation is, well, it's basically an accounting fiction. It's just a non-cash estimate of wear and tear. And because of that, it is completely disallowed in an NPV calculation. You absolutely must exclude it. Capital allowances, on the flip side, are totally cash relevant. They're based on strict government-set rules, and they directly impact the actual tax you pay. So they absolutely have to be included in your NPV calculations. Let's walk through how this actually plays out in reality. Step 1, you buy the asset. Step 2, you claim the allowance. Now, in the UK, as our source notes point out, a super common rate is an 18% reducing balance allowance. But, and pay really close attention to Step 3 here, you receive the tax cash saving the following year. Oh yeah, the pain of paying taxes might be immediate, but the cash relief, that hits a full year later. This is an absolutely classic exam trick. The tax relief reduces your tax payable, sure, but that physical cash benefit doesn't hit your bank account until the year after the allowance is claimed. When it comes to NPV, timing is literally everything. Okay, now that we've handled the government, let's transition over to our second real-world hurdle in Section 3, tackling inflation and NPV. This is the silent thief of your purchasing power. To handle this silent thief, we need a specific mathematical relationship, which is the Fisher equation. It tells us that 1 plus the money rate equals 1 plus the real rate multiplied by 1 plus the inflation rate. The money rate is essentially your nominal rate. It's what you actually see quoted out there in the market, and it already includes inflation. The real rate, on the other hand, strips inflation right out, showing you the actual growth in purchasing power. You really need to understand how these three variables interact to accurately appraise any project. And this math builds right into the absolute most important mantra for dealing with inflation in finance, the consistency rule. It's simple but crucial. you must match your cash flow type to your discount rate. If you're dealing with money cash flows, meaning the numbers already include the effects of inflation, you absolutely must discount them using the money rate. If you're using real cash flows, you must use the real rate. Mixing these up is a totally fatal error. It will literally ruin your entire NPV calculation, so be careful. Let's also point out a few very specific nuances about inflation from our notes. First off, if you're given cash flows in current prices, you've got to inflate them year by year using the specific inflation rate to turn them into money cash flows. Second, and honestly, people forget this all the time, inflation doesn't just affect your sales revenue and material costs. Your working capital requirements, the actual cash tied up in day-to-day operations like inventory and receivables, those often increase with inflation too. So you must include these inflated working capital needs as cash outflows. All right, so we've conquered taxes and we've handled inflation. Let's bring in our final hurdle for today in Section 4, surviving capital rationing. Now, what happens when you have fantastic, positive NPV projects, but you just completely run out of cash? Well, scarcity basically comes in two flavors here. Hard rationing is an external boundary. This means the capital markets literally refuse to lend you a single penny more. Soft rationing, though, is internal. The money might technically be out there in the market, but your own management team has set a strict, hard stop budget limit. But honestly, whether it's hard or soft, the reality on the ground is exactly the same. You have a hard limit on your funds, and you're going to have to choose between your positive NPV projects. So the crucial point is, how do we actually make that choice? Enter your ultimate weapon for single-period capital rationing, the profitability index, or PI. PI is just your net present value divided by your initial investment. Rather than just looking at the big total wealth the project creates, PI tells you exactly how much value is being created per unit of that scarce capital. Just imagine a scenario where Project A has a higher absolute NPV of £50 compared to Project B's £40. Now, without capital rationing, you'd obviously prefer A, right? But look at the investment cost. Project A costs £100 to get off the ground, which gives it a profitability index of 0.5. Project B only costs £50, giving it a PI of 0.8. Because Project B generates 80 pence of value for every single pound invested, compared to A's 50 pence, Project B actually ranks first. It's just a way more efficient use of your scarce cash. Wow. Okay, we have covered a lot of ground today. Now, let's transition to our tactical conclusion in Section 5, avoiding common exam traps. Time to put on our detective hats. Let's rapid-fire some crucial fixes straight from the examiner's reports to make sure you secure maximum marks. Trap number 1, completely ignoring working capital recovery. The fix? You absolutely must release working capital as a cash inflow at the very end of the project. Trap number 2, using accounting profit instead of cash. The fix? Always use cash. If you're only given profit, you have to add back depreciation because it's a non-cash expense. And finally, trap number 3, messing up tax timing. The fix? Never forget that tricky one-year tax lag for your capital allowance tax shields. To wrap things up, I really want to leave you with this final provocative thought. How will these real-world constraints, taxes, inflation, and scarcity change the fate of your company's next big project? Because look, a basic spreadsheet might say a project is a go, but once you apply that tax lag, adjust for inflation using the consistency rule, and rank it using the profitability index, well, that supposed winner might actually be a huge loser. Mastering these concepts doesn't just help you pass your ACCA exams, it legitimately makes you a vastly more competent financial professional in the real world. Keep these concepts fresh in your mind, apply them rigorously, and I will see you in the next explainer.